Are you planning to buy your first house in 2023? If the answer is yes, this video is for you. In today's video, we'll be discussing the step-by-step process, the watch-outs, the mistakes that people do while buying a house, and in the end, we'll also discuss, is this the right time to buy as a first-time home buyer or not? So let's get started. So like I said, in today's presentation, we'll be discussing about the minimum requirements that you need as a first-time home buyer to buy a house. We'll be talking about some of the common myths that a lot of first-time home buyers I talk to actually have. And then we'll also be talking about value of choosing your team. That's a really important one, not because I'm a mortgage agent and you should choose me. It's really important and we'll discuss why. And then we'll also talk about the step-by-step process of home buying. And it's important because there are in fact 15 steps involved in a home buying process. And I'll also talk about what happens in each part of that process. First, let's talk about the minimum requirements to buy a house. Now, we need a working status in Canada. Ideally, you should be a PR holder or a citizen. Now, sometimes it's okay to buy on a work permit as well. For instance, if you are buying in Alberta, Nova Scotia, anywhere except for Ontario and British Columbia, you can actually buy a house just like a normal PR holder or a citizen with a minimum down payment of 5% or whatever that payment is. However, if you're in Ontario and BC, you have to pay something called as a non-resident speculation tax as a work permit holder. And that speculation tax varies by province. In Ontario, it's about 25% in whole of Ontario, and in BC, it's about 20% in most of BC. And therefore, I would not recommend you buying a house on work permit if you are in these two provinces. However, there are certain exceptions to it, and that is something that I do discuss when I talk to the clients one-to-one. So if you want to book a call around this, I'll be happy to do that. So ideally, if you are a first-time homebuyer, you should be a PR holder. And in some instances, if you are in Alberta and Nova Scotia, do book a call because you can actually buy a house on work permit as well without any repercussions of NRST, which is non-resident speculation tax. The second most important requirement is that you need 3 months of active Canadian tax-paid full-time job. It needs to be full-time if it's a new job. It needs to be at least 3 months. Ideally, it should be out of probation. However, if you have been working for 1 year and now you're in a new job with a probation, there are exceptions that can be made. But we basically need a minimum 3 months of active Canadian employment before you buy your first house. The third important requirement is that we need one active credit card with good payment history. Now, I see a lot of couples actually getting one credit card and a secondary credit card for the spouse. That should not be the case. It's always better to have one credit card in your primary names, at least one credit card for at least 3 to 6 months before you buy a house. Now, there are programs that can actually allow you to get a house at as little as 0 credit score. The minimum credit score that's required is in fact 650, maybe 680 in certain instances, but we need a minimum of one credit card so that there is some amount of credit history that's being built, and we'll talk about that in a bit as well. And last but not the least, minimum 5% down payment is required. I know a lot of people actually say that you can buy a house as little as 0% down. I don't get it how, and I don't get how you can do that in residential market. You need a minimum 5% down. I made an entire video on whether to do a 5% down or a 20% down. We talk about that in detail in a 20-minute video on down payment. I would highly recommend that you watch that. I'll actually link that in the description below. But these are the 4 main requirements that you need if you're buying your first house. Now, let's also talk about some of the common myths that a lot of people have, and I'll just bust those one by one. Now, the first main important myth is that everyone can buy a house with 5% down. That's in fact not true, especially if you are less than 1 year into Canada. And if you are planning to do 5% down on your house, make sure that you are booking a call with me so that we understand your situation and we understand if you have the required documentation in order to establish enough credit. Because when we are less than 1 year into Canada, in fact, when we are less than 2 years into Canada, we don't have enough credit length. And the lender will not know whether you have a history of paying your bills on time, and therefore we require certain documentation which is additional, but that documentation purely depends on your personal situation. But that's definitely not true if you're buying a house of more than $1 million and you're doing a 5% down. If you're buying a house for $1 million, you have to do a 20% down, whether you're buying your first house or your 10th house. Now, related to this, there's another myth that 5% down is a first-time homebuyer advantage. That, in fact, is false. 5% down is an owner-occupied advantage. That basically means if you are buying a house to stay for yourself, then you can do a minimum down payment. If you're buying an investment property, let's say if you're buying your first house as an investment property, you still have to do a 20% down. So 5% down is an owner-occupied advantage, whether it's your first house or 10th. If you income qualify, you can actually do a less than 20% down or a minimum down payment on it. The second myth is that you need a 700 plus credit score to buy your first house. That in fact is not true. I've gotten approvals for people who have got less than 650 credit score, as long as it makes sense. As long as it makes sense why we have a low credit score. Now, most first time home buyers do not start with a great credit score, especially if you're buying a house in the first 6 months or 1 year, and it's okay. There are programs that can actually allow you to buy with a low credit score, and it does not impact your interest rates at all. You'll get the same interest rate, and sometimes even better if you are new to Canada and if you fit that program. So again, talk to a mortgage agent, because it's important to understand the nitty-gritties of buying your first house, especially if you're new to Canada. The third myth that I hear a lot is that you need 1 year of job before buying a house. Like I said in the previous slide, you only need 3 months of active employment in Canada in order to buy a house, and in most cases, it'll be nice if you are out of probation, but again, there are lenders who actually waive the probation and they give an exception on that as well. So that's completely false when people say that you need 1 year of active employment. You just need 3 months to get approved for a mortgage. And the fourth myth is that you cannot buy a house in work permit. Now, you can buy a house in whole of Canada if you're on work permit. The only difference is if you're in Ontario and BC, you'll be paying NRST, like I said in the previous slide. But if you're in Alberta and Nova Scotia, you can actually buy a house with as little as 5% of the minimum down payment. The same rules that apply to a PR apply to a work permit holder as well. And that's something that a lot of people do not know. Now, before we move on to the steps that are involved in getting your house, there's an important step in between that a lot of people miss. It's choosing your team. The first person that you need to be comfortable with is a mortgage agent. The second one is a realtor, and the third one is a real estate lawyer. It cannot be any lawyer. They have to have a real estate license. So make sure that you're working with a good real estate lawyer. Now, in most cases, if you have a good realtor and a mortgage agent, they will be working with real estate lawyers, and you can just use those lawyers because the mortgage agent and the realtor have already built a rapport with the lawyer, and it's important that we work with them because that's how we ensure that the transaction actually goes smoothly, and if there's anything that goes wrong, the mortgage agent or the realtor is able to fix it for you. Now, there are certain things that we need to do and not do when we are choosing a team. Number one thing is that we need to understand what their niche is. For example, if you're choosing a realtor and if they don't have a house of their own, I would not be very comfortable working with that realtor. Same way, when you're choosing a mortgage agent and you are owning a commercial property, I'm not a commercial expert. I'm not someone who does commercial mortgages, and therefore you would not reach out to me. However, I've done more than 100 transactions in the last 1 year for first-time home buyers and first-time investors. And if you are a first-time home buyer, that's the person that you want to work with. I'm not saying that you have to work with me. All I'm saying is that when you're buying a house, your team has to be able to understand what you are going through, because it's your first house and there are nerves and there are questions that might seem very basic for an investor level realtor or a realtor who has 20 years of experience or a mortgage agent who has 20 years of experience, but they may not be as obvious to you. The second most important thing in a realtor or a mortgage agent, or for that matter a real estate lawyer, will be that are they educating you? It's very important as a first-time home buyer, especially when you don't know a lot of things in the process. We need to understand and work with people who are explaining us everything. Even if you're not into numbers, they should be able to explain you the numbers, because it's big money involved. There's a lot of down payment that goes into it. It's a very important decision, and we can't be okay with when someone who is licensed like a mortgage agent or a realtor says that aap tension mat lo, ho jayega. That's not a phrase that you would want to hear from a licensed profession as a first-time home buyer, and it's important to understand what's happening with your mortgage or with the house that you're buying, and therefore I personally would always work with someone who educates me. And the third most important thing is that mortgage agent or the realtor is being transparent with you. Even if there's bad news to be delivered, it needs to be delivered quickly, and it needs to be delivered with full transparency, with no filters, so that there could be a plan B and a plan C that could be made. And that's really important. Now, let's also talk about how not to choose a team. And the number one thing is going straight to the bank for the best rate. In most cases, I would not be comfortable doing that. And the reason for that is that I don't know if the bank employee or the advisor actually is talking in my best interest, because they are working with whatever bank they are working with. They have to talk in their interest. With a mortgage agent, because they have access to all the products and all the banks, they are able to provide you with the best product possible, and they'll give explanations of why we are choosing this particular bank versus that particular bank. And that's really important. Again, transparency is important, and a mortgage agent is able to provide you with a little better transparency. That's the reason why I joined the profession. I'm not just saying this because I am a mortgage agent. I'm saying this because I have had experience of working with banks and mortgage agents. And from a guidance point of view, mortgage agents are way better. And even from a rates point of view, they have access, and we have access to products that are way cheaper when it comes to even interest rates. The second mistake that I see a lot of first time home buyers is going towards realtors who are giving cash back. And that's something that I won't say I'm against it, but I'm not in favor of going with those realtors. The reason is very simple. If someone is giving you cash back, you are actually going to them for the cash back and not for guidance. You would rather want to save money on the buy, save $50,000 on the purchase price than get the $5,000 in cash back. I would always choose a realtor who would fight to get me the lowest rate possible on the purchase than giving me a 1% cash back. That's just me. You could be different. It's just something that I see a lot of people doing and I feel it's wrong. We need to go for the right guidance and the person who actually fights for the purchase price and not just give a cash back. And the third thing that we need to avoid is saving pennies on the dollars. I see a lot of people actually saving $200-300 on a lawyer who is not that good, but they are charging a little bit less. And what that does is at the end of the transaction, they are not picking up calls on closing day. This actually happened the other day when one of my clients actually chose a realtor who was charging $300 less than my lawyer, the lawyer that I usually work with, and they did not pick up the call till 5 p.m. in the evening. And that's frustrating, not just for me, but for the client as well, because they didn't know whether the file has closed or not. So never try to save $100, $200, $300 when you're making such a massive purchase. It's really important for our peace of mind that everything goes smoothly, and therefore it's important to choose the right team, not the cheapest team. And finally, the fourth biggest mistake is not giving a thought to the team that you'll be working with. I always believe that you should have your realtor, your mortgage agent, and your real estate lawyer before you are actually seeing your first house. It's really important that you do that. Now, if you reach out to me as a mortgage agent, I'll make sure that I connect you to the best realtor and the best real estate lawyer, but you can actually do that with a realtor as well. If you are reaching out to a realtor, make sure that they are referring you to people who are actually really good, and don't take their word for it. Work with them, talk to them, and work with someone who is in your niche, who is transparent, and who is educating you. Now, finally, let's talk about the process involved. Now, it's a very simple process, but I'll break this down into 15 easy to understand steps. The first one is choosing your team. We talked about this. We need to understand who is working and who we are working with, who we are comfortable with. The second step here is that we need to get pre-qualified. That's where you reach out to a mortgage agent or a bank and you need to understand how much you qualify for. Now, in this, I will highly recommend that you download my Rule of 35 calculator that actually says that your household expenses, like the home related expenses, which is your mortgage, condo fee, utility bill, should not exceed 35% of your net income. That's not how a bank qualifies you, but that's something that will force you to buy something that you can actually afford even if the interest rates increase. So when clients reach out to me via my website, I always make sure that I set up a video call, and on that video call, I share my screen and I do the entire eligibility, and I make sure that I tell my clients why they qualify for what they qualify. Again, transparency is important, and I try to do that with my clients. The third most important thing, and that's something that people actually do as point number 2 or point number 1, while they should be doing it at point number 3, because when we know how much we qualify for, now we can actually decide on the location. Maybe we decide on the province, and we also decide whether we want to buy a condo, townhouse, semi-detached. All this can be determined based on our budget and budget alone. Now, the fourth step is simple. We just go and look at houses, whether we do it online or with a realtor. We just need to roam around the neighborhoods. We need to have a checklist of the house that we want. We need to have the must-haves and the things that are okay to have. All that needs to be told to the realtor so that they are sending you the right houses that you can afford. The next step here is putting an offer. Now that you like a house, you need to put an offer. Usually you put a 5-day working condition on this, and you also pay a deposit. Now, this basically is called a conditional offer. When you're putting an offer, you can put conditions on inspection. You can put conditions on, if it's a condo status certificate review. We'll talk about that in a bit. And you can also put a third condition on financing review. Now, what that does is it gives you 5 working days in order to get all these 3 things in order. Now, you will be paying a deposit. Let's say that's $10,000. Just in India, we used to say Piana. This is a deposit here that you pay in a trust account. If any of these 3 conditions do not satisfy, you can actually get the deposit back in 5 to 7 working days. It's as simple as that. So this part of the process of putting a conditional offer takes the risk out of the game. And if you do not get the financing, for instance, or if the inspection doesn't check out, you just don't get the house and you get the deposit back. Now, with my clients, when they are putting an offer, they call me to make sure that the offer that they are putting will be accepted. So I look at the ratios again, and I then tell them this is the maximum we can go on the house. So even though it's a conditional offer and I know that we'll have 5 working days to satisfy the conditions, I just want to make sure, in interest of time for everyone, right? I don't want you to waste your time. I don't want us to waste the realtor's time. We need to be putting an offer that actually makes sense for us and we can be approved for. So we just take the risk out of, even before putting the offer, we just take the risk out of financing. And of course, we have the conditional offer, and therefore we have 0 risk, because even after you put that offer, we have 5 days to say no if something is to go wrong. The next step is that there is an accepted offer, the seller has agreed to your purchase price, and now you send the agreement to the mortgage agent. The next step is that we choose a lender. So what I usually do is, because I have access to multiple lenders, I'll give 4 or 5 or 6 different options. We'll talk about prepayment penalties, we'll talk about interest rates, we'll talk about payments, we'll talk about pros and cons of going with each of the lenders, and we take the emotion out of it. Just because we have an account with a particular bank, that doesn't mean that that bank is right for us. So we take the emotion out of it, we take our associations out of it, and because mortgage agent has access to multiple lenders, you can actually make a more informed decision that's right for you. The next step is in fact 3 steps that happen in those 5 working days that we have put a condition for. Number 1 is that I as a mortgage agent will be applying for a mortgage. It usually takes about 2 to 5 working days to get an approval. It's a conditional approval based on that every document that we have provided is legit. They do a fraud check, they do anti-money laundering check, they do all sorts of compliance checks to make sure that whatever we have submitted is okay. But as long as that's there, they will conditionally approve us in 2 to 5 working days, and then the risk of financing actually goes away as long as we have not lied on the application. Now, while the mortgage agent is getting a financing approval, the realtor will actually get you an inspection done. Now, see a lot of people saving $500, $600 on inspection, especially if you are buying a whole house. Make sure that you take that risk out of the game and you inspect the house for mold, for creaky floors. It's a really comprehensive inspection report that you get in $500. And even if you are not to see the house at all and you see the inspection report, you can actually make a call whether you will buy the house or not. And the other thing that needs to be done here, especially if you're buying a condo, is involve the lawyer to check the status review. Status review is basically the condo management. We need to make sure that their financials are in place, they have enough reserve funds, their cash flow is not negative, they are actually making money every single month, every single year, and there is no pending case with the condo management. All these things are important because lenders don't lend if there's a problem in the condo status certificates, and therefore in those 4 to 5 working days that we have, the conditional offer that we have put, we need to involve a lawyer. Now, if you're working with a good realtor and a mortgage agent, like I said before, you will get a good lawyer, and they usually would not charge you anything as long as you close with the same lawyer. The next step is that we put a firm offer. Now that the inspection has checked out, the condo certificates are good, and the financing has been approved, we put a firm offer. Now the deposit that we have paid, there are no takebacks on that. It's all done and we need to close the mortgage now. The next step now is to sign the mortgage documents. I usually set up a call with my clients. I take them through the 18-20 page document that we have. It looks like a very complicated document. It's not. I explain every single thing that impacts you in that document in detail, and that takes a lot of pressure off, especially if you are a first time home buyer. Now, the reason why I do that, I don't have to do that. No one did that with me. But the reason why I do that is because I am very scared of signing a 20-page document that I don't understand. And therefore, I make sure that I explain that document to the clients. So basically, from putting an offer all the way to signing the mortgage, it usually takes about 5 to 7 working days. And then comes the main boring part, which is compliance. Now, like I said, the lender has conditionally approved you based on the documents that they saw, but they still need to do an employment check. They still need to call your employer to make sure that you are actually employed. They still need to make sure that you don't lose your employment while the mortgage application is in process. They still need to make sure that the down payment that has come is not all cash. It's not money laundering. All those things still need to be checked, and that's part of compliance. Now, it's much more complicated than I just told you, but usually in my experience, as long as we have not lied on the application and as long as we are in the right and everything that we have done, I really don't see a reason why the lender will back out from the application. If the broker is transparent in the entire process and they are explaining everything that's happening and keeping the client in the right, there's no reason to believe that there will be any takebacks on this mortgage approval. Now, many times what happens is that the house actually closes. So from when you sign all the way to when you actually get the keys, there is a gap of about 30 to 60 days. Most of that gap is actually filled by compliance, but a lot of this gap is just because the seller actually doesn't want to give you the house before 90 days. It's not like the entire mortgage process is taking 90 days. It just means that the seller is not willing to vacate the property because they are living in it, or they have to buy another property in the meantime. They just don't want to leave the property in 90 days. And that's the reason why sometimes you see extended closing dates. It's not because mortgage is taking time, it's just because the seller actually wants the closing to be a little bit ahead. And sometimes even you as a buyer would want an extended closing because we need to collect a little more money in order to make the closing costs. Now that the mortgage is for sure approved and everything is all set and it's time for closing, 7 days before closing day, whatever is the closing day, 7 days or 8 days before, sometimes a little bit earlier as well, depending on how the lawyer is set up, the lawyer actually calls you in the office, or they do it virtually. It depends on the how the lawyer is set up, but they have to sign a few documents with you. They'll ask for a couple of documents that you've already shared with the mortgage agent. All you need to do is show up and sign those documents, and finally you get the keys on closing day and you move into the house. Now, from a timing point of view, the entire process takes as little as 30 days, but it could take as much as 90 days. It all depends on what you decide on the agreement when you're signing the agreement with the seller. From a cost point of view, the realtor is free for you because they get their money from the seller. The mortgage agent, in most cases, especially if you're going to a bank or if it's an A-lender deal, there's no charge at all because they get paid by the bank. The cost that you will incur is your closing cost. That will include your lawyer fees, your land transfer tax. All those costs taken together along with disbursements cost you about 1.5 to 2% of your purchase price. So if you're buying a house for $500,000, make sure that you're budgeting, apart from your down payment, you're also budgeting $7,500 to $10,000 if you are a first-time home buyer and if you're getting a rebate. If you're a second, third, fourth-time home buyer, make sure that you're budgeting 2.5% to 3% because you do not have the land transfer tax rebate on your second buy. You'll see some boxes which are dark blue, some boxes which are white. Now, all the places that you see in dark blue versus white, the dark blue ones are the ones where mortgage agent is involved. I'm actually involved with my clients all throughout the process, right from sometimes choosing the team all the way to getting the keys. And there are certain aspects where mortgage agent has to get involved a little bit more deeper than the realtor and the lawyer. Now that I'm making a video on buying a house, how can I miss this question? Should you buy a house now? As a first-time home buyer, is this the right time to buy? I get this question a lot. Let me just explain this by numbers. Now, I can't answer this because I don't know what Bank of Canada will do in future. We can only speculate. We can only look at economists, what they are saying. And the economists are saying that we'll probably see another price increase rate hike in December, and then they'll stop for an entire year. I don't expect the rates to go down in 2023. I do expect the rates to go down in 2024 and 2025. But let's just look at numbers and see the difference between if you buy a house in January 2022, if you bought a house then versus if you buy now, and if it makes sense. Now, the home price, the average, let's say in Kitchener, because I know this area very well, in Kitchener, the home prices, the average home price was about $950,000, even for a townhouse. The townhouse that we bought actually sold for about $980,000 back in January. If you were to buy in January, it was $950,000. Now the same townhouse or an average home price in Kitchener-Waterloo is $750,000. So it's $200,000 lower. What that means is lower down payment. For instance, if you're doing a 10% down payment, you'll be doing $95,000 versus $75,000 right now. So off the bat, you save $20,000 on the down payment. Then your default insurance will also be less because default insurance is, this is basically the mortgage insurance because you're not doing a 20% down. There's a mortgage insurance that is being charged, and that is usually 3.1% of your mortgage amount. So this obviously will be higher because the mortgage amount is higher. The total loan that you would have taken in January 2022 was $881,000. Now for the same house, because the price has been lowered, you are now taking a loan of $695,000. That's almost $180,000 lower. Now the mortgage payments need to be discussed a little bit differently. Back in Jan of 2022, the mortgage payments were, because the low interest rates of 1.5% on average, and sometimes you could actually get from some lenders at 0.99%, the interest rates were very low. And therefore, even when you take an $880,000 mortgage, the mortgage payment was as low as 3,521. Now, if you were on an adjustable rate, I'm not saying it's a bad thing to do. I've actually made an entire video on what rate is best for you. Do watch that video. But those mortgage payments have increased by about $1,200 to $1,500 because the interest rates have increased from 1.5 to 4.5% for those people. Now, if you were to buy a house right now, you would see that the monthly payment will be in fact 4,218 because the interest rates, after I'm assuming a 0.5% interest rate increase in December of this year, 2022, at the time of shooting this video, will be between 5 to 5.5%, and that would put your payment at over $4,200. So in theory, you're actually paying $700 more, but this is not like-to-like comparison because the interest rate back then was 1.5% and right now it's 5.5%. I promise I have a point that I'll be making by the end of this. Now let's assume from now, when you buy the house at $750, the home prices appreciate every year by 7%. This is a very conservative estimate. The home prices have actually increased by a lot more than this, but let's assume it increased 7% every single year, and that would put the home price by the end of 2027 at $1 million. And that would mean that your outstanding outstanding balance, because you have paid down your mortgage in 5 years as well, the outstanding balance, if you were bought in January 2022, was 778,000. So your 881 has reduced to 778. So you have paid down about $100,000, and you have also paid down about $90,000 because the interest rate is much higher. You are paying more interest, less principal, and therefore you have paid down your mortgage by a lot less. But 695 has still reduced to about $618,000, and the equity, even if you bought at the peak, would be $222,000, but it will be a lot higher if you were to buy a house right now. Because we need to understand that interest rates are high and therefore the house prices are low, and you cannot change the house price once you buy it, but you can change your interest rate even after 3, 4, 5 years when the interest rates start to come down. So one of my mentors actually says that you marry your purchase price, but you date interest rates, and that interest rate can change. But it's very difficult to change your purchase price. It's in fact impossible to change your purchase price. So not only did you save the money on the buy, which is $20,000 because of the lower down payment, because the house price was lower, if the interest rates come back to 4%, which is a 25-year average of variable interest rates, your mortgage payment will actually be not very different from what you were paying at a $950,000 purchase and a 1.5% interest rate. So 1.5% interest rates, which is very low. I don't think we'll see those low interest rates again, but the mortgage payment will be very similar at 4% just because you bought the house, the same house, at $200,000 lower. Besides, as a first-time home buyer, what's the alternative? We'll have to rent. Let's assume a $2,000 rent. For 12 months, you'll be paying $24,000 towards someone else's mortgage. Now, I'm not a huge fan of saying that you should not be paying someone else's mortgage, but over long term, if you look at this and a meager $100 increase per year in rent, if you rent for 5 years, you'll be out $132,000 in rent with zero equity. Now, just because you're paying someone else's mortgage doesn't mean that you should get a house. I would highly recommend that you download this calculator that I made. This actually gives you a number based on the household income that you get net after taxes. It actually, puts in a few variables there, that how much down payment are you making? Are you expecting, a hike in the next 12 months? Do you have emergency fund? If you have an emergency fund, the calculations are very different. And then it takes into consideration the annual property taxes, the utility bill. It takes into consideration real costs and real numbers. And that's how it gives you the home purchase price, which is ideal for your situation. I would highly recommend that you download this calculator, and what would be best is you book a call with me. Just fill the form in the description. I'll be asking, there'll be an email that will come to you. It'll be asking for a couple of documents. Just submit the documents. We can then talk and I'll take you through the entire process and make it more customizable for you. That's all I have for today. I hope you like this video. The intent of this video was to give you an end-to-end process of what it takes to buy a house. What are the watchouts? What are the myths? And I would highly recommend that you talk to a licensed mortgage agent or you book a call with me and discuss your situation, because every situation is different. Mortgage is an individual sport. But I hope that you liked this video. If you did, do share this video with other first-time home buyers. Do subscribe to the channel, because there are a lot of these videos that I'll be making. I actually like to go deep into these topics on this channel. So if you are looking at that depth, and if you are looking for in detail information on buying a house or investing in real estate or stocks, some other things in business as well, I'll be making a lot of business related videos as well as we go into 2023. So do subscribe to the channel. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.